Hi everyone, good evening. Welcome back to our LLF Let's Learn Futures webinar series. How are you doing? I hope you're doing well and fine because it's been quite a while where our country has been opening for all interstate traveling. So today's topic will be about the inter-market quantitative modeling for FCBO and FKLI trading. So this LLF webinar series is brought to you by Bursa Malaysia and in collaboration with our company Excellent. And this webinar will be starting from 8:30 until 10. And my name is CY Som. I will be your moderator for today. And today we will be having Alex Siu. He will be sharing with you an informative topic about how you can do intermarket quantitative modeling for FCPO and FKLI trading. So I believe a lot of you knows about the two major school of analysis in the market, right? Which is the fundamental analysis as well as technical analysis to trade the market. And there is actually another type of analysis, which is called the quantitative analysis, where you can actually use mathematics and statistics to develop trading strategies. So I just want to give you all a heads up today as this topic may be a little bit advanced for you. So in today's topic, if you don't get it or understand it at the first time, it's okay. All you need to do is just keep an open mind to explore new ideas and methods of trading. Learn the core concepts as well as learn what are the principles that is behind quantitative analysis. Now, before we begin, if you can hear me, type in OK or yes in the chat box so that you are able to listen to me clearly. And you can also adjust your volume so that it is audible and you can listen to my voice clearly. Ready? Are you good to go? Great. Now, as you may have not already know that, sometimes our internet may have some disruptions. So if you want to make sure that you can enjoy the smoothest and highest quality video possible, please turn off your video camera so that you can enjoy a smooth video and have a good learning experience. Now, our session for today will be divided into two sessions. So the first hour will be presented by Alex. Then we will be opening up for Q&A session. So if you have any questions along the way, you can type in your questions in the Q&A box, and we will answer your questions later during the Q&A session. So remember to type in your questions in the Q&A box and make sure it is sent to all co-hosts. By that way, only I am able to actually grab your question from the Q&A box because there may be a lot of interactions and conversations happening in the chat box, and I may miss out or may not see your questions, okay? So to make sure that your questions is able to reach me, all you need to do is actually follow these two steps so that I can receive your question. As this LLF Let's Learn Futures webinar series is brought to you by Bursa Malaysia, we have several interesting upcoming topics that will be presented to you as well. So each and every Tuesday, we will be having this LLF webinar, and it will be conducted in 3 languages, English, Malay, and Mandarin. So if you're interested in trading Malaysia futures, whether is it FCPO or FKLI, or even if you're just interested in adding futures into your portfolio. So all of these LLF webinar is definitely right for you, where our speakers will be sharing with you their insightful knowledge and practical strategies related to futures trading. And there is also a lot more content-packed and informative topics lining up, and we will be adding to our list accordingly. So if you are interested in any topics and if you want to improve your knowledge and skills on the futures trading, you can scan this QR code and register yourself and make sure to add into your calendar so you don't miss any of the sessions that you're interested in. One more thing is that, besides the LLF webinar series, we also have the LLF online workshop. And of course, this online workshop is actually for those who are more serious in getting started in futures trading. So in these workshops, we will be covering the full set of beginner's knowledge in futures trading that are important and essential for you. So and this is actually a step-by-step guide to enable you to kickstart your first future contract. And each of these sessions is about 3 hours. And all of our previous sessions are actually full, and it's actually quite about the end of the year already. So remember to quickly register yourself in this online workshop because it is free and fully sponsored by Pusat Malaysia. And you can see at this date, 27th of November, this is actually the last session for both workshop 1 and workshop 2. So if you have already missed out the previous either workshops, so make sure that you register yourself in these dates and block out your calendar so you don't miss any of this opportunity. Okay, I repeat, these 2 workshops is actually the last session for this year. So remember to register yourself if you miss a previous session. So whereas for those of you who are really serious in kickstarting your futures trading, so make sure you quickly register this and grab your seat, because each of these workshop is only limited to the 50 online attendees only. All right. Now let me introduce our speaker for today. His name is Alex Siu. Alex is actually the first chairman of Malaysia chapter of CMT Association. He has extensive experience in the fund management industry. And formerly, he served as a fund manager in VCB Capital, a boutique asset management company, for more than 5 years. And currently, Alex is the fund director of a SC licensed robo-advisory firm, which is called the BH Global Fintech Solutions Sendirian Berhad. And Alex, he is specializing in trading systems and strategies, value investing, trading psychology, as well as he loves to design and developing programming on a machine learning algorithm for robo-advisory. So without further ado, let me pass the presentation to Alex.
Hi, so thank you so much. Hello, everyone. Yeah, good evening to everyone. Hope everyone stays safe and good during this pandemic time. Yeah, so it's good that we can continue to work from home safely, and we are also able to trade, and the market is still open. So if you're really bored, you can always try out attending SOL and Excellence classes. Yeah, that will be quite fun if you're really bored. Yeah. So let me share my slide for tonight. Yeah, the purpose, of course, is for education purpose only. I will not be selling anything or promoting any software. Yeah. So if you have any question, you can always type at the chat box. I believe there's a chat box. Yeah. Okay. So how many of you is the first time actually seeing me? You write a 1. If you have actually attended my class before, can you write a 2? Yeah, so that I know. Yeah, so that, okay, so that let me just gauge how many of you is it the first time. Okay, wow, so many of you first time seeing me, is it? Okay, yeah. Okay, all right, 1. Okay, 1, I see 1, 2. The rest are all 1s. Oh, 2, 2. Okay, I can see about 90 more people now. Okay, it's good to see all of you. Yeah, I'm sure, you know, face-to-face interaction is the best, but we are able to communicate or interact through Zoom and Webex is also not too bad. Yeah, at least we can communicate with each other. Okay, so hope everyone will keep up the good spirit. Okay, and you are able to learn and as well still continue to enjoy learning how to trade in this challenging market. Yeah, there are a lot of people asking me how come we cannot find BH app in the Android, you know, or the Apple Store. Actually, the app is called Airo, A-I-R-O. Okay, so for those of you who wonders, it's actually called Airo. So because too many people ask me, so I'll just answer here. Okay, so let me just share and started this this class. Okay, yeah, sharing. Okay, all right. Okay, all right. Today basically is on intermarket quantitative modeling. Okay, it's different from what I do every day. Nowadays, I'm quite busy with basically ETF. That's what we do. All other robots in Malaysia, they are also doing ETF. I think robot is a new thing. All of you are very curious. There are a lot of my friends ask me, what does a robot do? Does robot trade FCPO? Does robot trade FKLI? You know, because some of the Malaysians they are not aware what is ETF, so they still hope that all these SC approved or licensed robots can trade FCPO and FKOI. Unfortunately, they don't. Okay, none of the robots in Malaysia. So if you are really interested in FCPO and FKOI, you still have to trade it yourself. Okay, so that's why it's still good to learn. You cannot leave it to the robot to trade it for you. There are no such robots. As far as I know, there are no such robots, approved licensed robots in the world that actually can trade FCPO and FKOI on your behalf. So it's still good that you still educate yourself with the skills and knowledge on how to trade. Okay. Today's topic, those of you who actually have attended my class last time before, that you know that sometimes I speak too technical. Yeah, I hope you don't mind. And if you have questions, you can always ask me at the end of the session. Okay, there will be a Q&A session. And today's topic is very specific on intermarket quantitative modeling. I also include in how to automate because there were some requests from the past that I did not repeat again. Actually, I did that in the first session. Then after the second session, I didn't talk about it. So they will request that I should also talk about, after I do this model, how do we automate the model and make it, trade using whatever platform, like whatever broker they're using. So that will be included as well. Okay, so I hope that you stay tuned and enjoy today's class. Okay, intermarket quantitative modeling. All right, I won't say I'm a professional quant because we have quants in our company. Yeah, I am just a fund manager. So quite broad, overseeing quants and all other things. I'm also not a professional programmer, right? But it is important for me to actually know whether the strategy works or not. Yeah, that's my job, is on the strategy design. Okay, so I'll just go for the first part. Why we want to do quantitative modeling in the first place? Okay, it's because we want something more precise. We want something more standardized, something more systematic instead of relying on gut feeling. That's the reason why we, after having fundamental analysis, okay, which is global macro views and all these things, and also technical analysis, which is looking at charts, we still want to look at quantitative modeling, okay, because it's something, okay, that is actually of more precise nature, right? Quantitative modeling started to become popular after in the 90s, where I think Goldman Sachs is one of the earliest, okay, to start their trading models using quantitative modeling. Nowadays, a lot of old Goldman Sachs white papers are all published free and for available to the public. So if you're interested in all the earliest, okay, quantitative modeling white papers, what type of strategy does Goldman Sachs use in the 90s and all this in the early 2000s, you can always go online and search, okay? Emmanuel Derman, if I'm not wrong, that's the name of their head of quant. Yeah, search his name, okay, and also search, you can search Goldman Sachs trading white papers or something like that. This Googles these keywords and you'll be able to find their early strategies, very quantitative in nature, even in the early 90s and 2000s. Okay, so I will start with a basic understanding of the QA, quantitative analysis, using eView. Okay, so of course, first of all, is to prepare the data. So where to get the data for FCPO and FKOI? Actually, for the last few sessions, I have actually mentioned about it. You can definitely download free, okay, from the, let's say, Yahoo Finance, Google Finance, but the data might not be, or even from TradingView, but the data may not be 100% reliable, mainly because they are free. It's better if you get from maybe Bursa Station, yeah, which costs money, but the data are more accurate. Extract the data, and then put it into Excel, and from Excel you can actually import into eViews. That's where you can actually do certain quantitative modeling with it. Of course, there are other software that you can do quant modeling. The previous talk I talked about using MATLAB, yeah, to do quantitative modeling. This time I've been talking about eView. Okay, right. So there are a few software, SPSS and also SAS. These are some of the software you can use to do quant modeling with. Okay, all right. First of all, it's a raw data. Okay, let's say if you do ETF, because nowadays I process a lot of ETF, so I just use ETF example. It equally applies to FCPO and FKOI. Okay, the data always starts with raw data having unit roots. Unit roots meaning that the data by itself is not suitable to do quantitative modeling. You have to process the data first to remove the unit root. That is actually the first thing to do. And how to do that? Okay, let's just have a look. Okay, right. So after you extract out the data from USA Station, okay, or from Excel or Yahoo Finance, you put into Excel as a CSV file, okay, is fine. XLS file is also fine because nowadays the later versions of eView can read both versions of Excel. So after you put into Excel, and it's a raw file, as you can see here, it's actually different ETF, or as a raw ETF data, and then you can go to open, you open up your eView. eView is a software. Okay, of course, I'm not promoting software. I'm just telling you what are the software I myself use to do all this quantitative modeling. Okay, of course, now it's my staff are doing it, right? Not me. Okay, but I used to do this myself, and these are the things that you can explore. Okay, of course, these softwares are definitely not cheap if you want to buy the original version. Okay, right. eView, go to File, Open, okay, and then choose Foreign Data as Work File. Okay, Foreign Data as Work File. Right, you choose that, and then you'll be given a choice to open up Excel format file. Okay, once you open up just now this file, this file, you save it as certain file name after you extract out the data. Let's say FCPO data of different months, FCPO months, and also FKR data in the same way, and then you open this up in the eView. Okay, and then what you see is the right hand side here. All the different columns become one item inside eView. Okay, inside eView. So let's say this is one of the item. For example, this is one of the FCPO data or FKR data. Here is a ARKF, which is a ARK FinTech ETF data. You double click it, that is a normal chart. What you see here is just a normal graph. Yeah, this is called a graph with unit roots. Okay, last time in the past, a lot of technical analysis indicators are based on raw data when they program their indicators or they design their indicators. That's why there are actually 3 problems that were not addressed in the olden days because they were not aware that there is a problem of unit roots, there's a problem of serial correlation, and there's a problem of heteroscedasticity. I addresses these 3 issues in the previous talk. Okay, so I'm not going to address it again because it will be stretching the whole talk. Okay, so these 3 issues, the previous creators of technical indicators, for example, from CMT, like John Bollinger, like Martin Pring, Daryl Guppy, these people, Gerard Apple and their children now is the son, John Bollinger's son, Gerard Apple's son, they are now designing indicators. Now they are aware that these are the things that they must take into account when they design an indicator. But the reason why the old indicators in the 1960s, right, like MACD, stochastics, in the 1950s, moving average, okay, and in the 1970s, Bollinger Band, why were they not that accurate? Is because these 3 problems they did not take into account. They were not aware that such problem exists. So today, when we design a new indicator, you are aware that these are the problems that you must address, okay, which is heteroscedasticity issue, serial correlation issue, as well as a unit root issue. So the original FCPO time series looks like this. It's just an original graph. This is a plain graph which has unit root with it. Okay, so it is a non-stationary data. Okay, so if you want to do quantitative modeling on FCPO data like this graph, you cannot leave it as non-stationary. You have to make it stationary. That will mean removing the unit roots. Okay, take for example here, December FCPO contract data, open in eView. Okay, this is the data. Okay, and then from here, you can see that this is actually the normal chart, which is called a non-stationary chart. This is also the usual FCPO chart pattern. It's a usual chart. So by default, it's non-stationary. It cannot be used for statistical modeling. It cannot be used. You have to process it. So how do we process it is, you have to create a new data object in eView. You can call it D in front, DEC. You can call it any name, but I just give it a name, DEC. Okay, as you can see here, create a new data object inside eView. And then we create a new data object, call it DEC. Okay, it's under new data object series, under time series, and then give it a name, click OK. Yeah, click OK. So what you see here is that you have created a new data object, and it's called DDEC, and this DDEC is an empty object. You can click outside, inside is all NA, means that there's no data inside. It's an empty container, it's an empty vessel where later on you want to put a stationary data inside. Okay, so now it's empty. So what you do now is you do a first level differencing step is here. Inside the eView, you type this command, DDEC is equal to D bracket DEC. It means you want to do a one level differencing. You click it, and then you'll be able to see that successful downstairs. You will say that this is successful. Okay, means you have successfully done, remove the unit root. That's what you have done. You remove the unit root, and you have done your first level differencing step. Okay, so what's next is you can just check. You can check and open up the chart after you have done. You can see this is a normal chart that we first have. This is the chart after you have done that extra step of removing the unit root. You can see now the chart is stationary. It fluctuates in a central mean of 0. This is called the right hand side is called a stationary chart. The left hand side is called a non-stationary chart. Okay, so that's the difference. So it's important to make the chart stationary in order to do quantitative analysis. So this was one of the things that I think the olden days, they were not aware that this is necessary. So that's one step, okay, to make your indicator more reliable or have a good quantitative model. First, you need to make your data stationary. So this is how the first level difference of data looks like. It looks like that. Okay, so if your data still looks like left-hand side, you know that you have not successfully made your data stationary, or you have not successfully remove your unit roots. Okay, right. So first level difference, remove unit root in eView. So left hand side is FCPO, right hand side is after the removing the unit root, it becomes something like this. This type of data is suitable to do quantitative modeling with. Okay, so very simple. You can see the step is very simple, right? It's just doing one step. Okay, click and then click the command and then press enter after tap this simple line, and then the data already becomes stationary. But a lot of new statistics students, they will forget to do this step. And for the rest of the tests are all useless. It becomes a spurious model, means that the model is no longer useful if you forget this step. This is one of the most fundamental steps to actually do, to perform. Okay, remember that. Remember, you have to do a remove unit root eView. Okay, you have to remember that. Okay. Then the second step, of course, if you want to check whether your FCPO data is suitable, okay, for let's say having a spread trading strategy, because a lot of Malaysian locals, they are using spread trading. They are not doing outright. Outright means you only, let's say, buy December contract. That's called outright. If you buy December contract and then you short January contract, okay, that is called doing a spread trading. And then whether is it suitable to choose that particular month for spread trading, that you can also check whether is this strategy suitable for this month's contract or not by using Johansson co-integration test. Okay, so what you can do in eView is you can go to group statistics, and then you can go to see Johansson's co-integration test to check whether this few data, let's for example December data, August data, and then November data, and next year January data, do they have something in common? Do they have some form of relationship, or is the relationship very loose? If the relationship is very loose, that means that they have no co-integration. So here, it actually shows that there is at least one pair has co-integration. There's actually some form of co-integration, because the probability of none is less than 0.05. That means that you have to reject none. It means that there is at least one pair has a integration relationship. That's what it means. Okay, if you don't understand, it doesn't matter. Okay, but I'm going more into very technical here. Okay, so here it shows that if you go further, dig further, it shows that August, September, October, November, December, different months of FCPO, this equally apply to FKLI. Yeah, it shows at least two pairs are co-integrated. That means that you can actually do intermarket modeling on these pairs. At the same time, you can also do spread trading on these pairs. It has two different applications if they are proven to be co-integrated. So this is one of the proof. Is Johansson's co-integration test is the proof whether they are co-integrated or not. Okay, so this proof that they are at least two pairs are co-integrated. Okay, that's what they've proven. All right, so you can choose Johansson's co-integration test. go further, okay, when you choose the test specification, you can go for the third one, intercept no trend in CE and test PAR. Lags, you can just choose 4 interval lags, and the rest you can just all leave it as default. I did not change anything. There's no need to change anything, yeah, unless you know exactly what you're doing. If not, just leave it at default, and then you'll be able to come up with this test result. Okay, so from the result, it shows that it has at least 2 co-integration. Because it's able to reject no co-integration, it's also able to reject at most 1 co-integration is rejected, means there's at least 2. But at most 2 is not rejected, means that you cannot say that there is at least 3, but you can say that there is at least 2, okay, because it's more than 1. Like it's more than 0, it's more than 1, but it's not more than 2. Okay, it's not proven to be more than 2. Okay, so this is actually where the Johansson's value, if the p-value is less than 0.05, is significant enough to reject the null hypothesis. The null hypothesis is that there is no co-integration. The alternative hypothesis is there is co-integration. And therefore, if you're able to reject the null hypothesis because your p-value is less than 0.05, you can prove that there is co-integration. And what does that apply? That implies that you can actually do intermarket modeling with it, and you can actually do spread trading. And you can make money from spread trading by doing the residue plot analysis method, okay, which I touched on the last talk. The last talk was on how to do spread trading, yeah. But this topic today is not going to do on that. It's going to do on intermarket. Okay, so if I have a chance to repeat all those topics next time, you'll be able to hear again what I said in the last topic if you have never attended the last 2 or 3 topics. Okay, so back to here, yeah. The co-integration test in MATLAB, okay, this was a bit touching on the previous topic. If you use CADF, co-integration augmented decay Fuller test, you can see that if the CADF value, the t statistics is very negative, it also as another way to prove that these few variables are co-integrated. Okay, you can see that if it's more negative than negative 3.089, you have 90% chance it will mean revert to each other. Means spread trading, you have 90% chance of success. Yeah, if this number is more negative than negative 3.404, there is 95% chance it will mean revert. Means if you do spread trading strategy on it, you have 95% chance of success. Yeah, and then if you have this value is more negative than negative 4.025, there is 1% critical value, you have 99% chance that it will mean revert. That means if you do spread trading on these 2 pairs, there is 99% chance of success. And that's where I touched on the last time. If you really want to do spread trading like a professional, you have to look at the CADF value so that you know exactly can you or can you not do spread trading on this pair of month, on these 2 calendar months. These are called calendar spread. Okay, calendar spread, which is often used by locals for their spread trading strategy. Okay, there are a few local prop firms, okay, who are doing spread trading of FCPO. So this is actually the thing to check on. Is it suitable or is it not suitable? Okay, so you can see the value here is negative 4.36. That means that it is very, very suitable to go for spread trading. It also means that it's very suitable to go for intermarket modeling because the products or the different calendar months data, there are some form of co-integration exists among them. Okay, so you make sure the data is ready. Okay, make sure the data is ready. Load the CADF test coding into MATLAB. Okay, this coding is actually written by us, right? So if you want this coding, if you want it, you have to run it in MATLAB. But if you want it, I can give it to you. Because these are all the old codes. We don't use this anymore. We have better codes already. Yeah, but these are all my very, very early days codes. If you want it, go ahead. Yeah, you can ask from the admin. You can pass this code to them. Yeah. So you just click run Johansson's co-integration test, okay, with this code, and then you'll be able to, you just have to run these codes. Okay, you will come out. Okay, what is the CADF statistic value? It will come up here. Okay, it will come up here. All right, you can see from here that it is actually negative 3.6688. Okay, here is a bit blocked, but it's actually somewhere here. Okay, so it's negative 3.6688 is actually more negative by negative 3.089, but it's also more negative than negative 3.404, but it's less negative than negative 4.025. What it means is that these few months of FCPO, they have at least 95% chance that you mean revert, but it does not pass a 99% chance. So that the 99% confident interval test, it did not pass, but it passed the 90 and the 95%, okay, confident interval test. That's what it did. Okay, so you can see here, the CFDA value is 90%, 95%, and 99%. This is the co-integration for a butterfly spread. Okay, September odd month versus offset months. Okay, if you are new to trading, definitely you will be blur of what I'm talking. This actually very much apply to very seasoned traders who are doing spread trading. This will enhance your knowledge of why are you doing spread trading, when should you do and when should you not do spread trading. It's really meant for advanced traders and who are very familiar with spread trading. Okay, this topic, because it's very technical. Okay, if in case you find it really blur. But those of you who know what I'm talking about, I think you will appreciate this, because not many people will share these trade secrets of how do you know when to spread and when not to spread and when to do outright. Yeah. So you have to look, you can use half-life calculation. Okay, load the residual spread. Load the residual spread, run the code, and you will see this is the residual spread. Okay, this is the residual spread. Okay, that is the upper confidence is where you should actually short the near month and long the far month. When you reach the lower spread, you should actually long the near month and this is you should short the near month and long the far month. Below here, you should long the near month and short the far month. Yeah, this is actually what you should do with this. Yeah, plus 0.5. Okay, you should short the August. Okay, and long set, and then negative 0.5, you should long August and short set, and so forth and so forth. Okay, this is actually how you can apply residual spread on it. This one actually I covered in the previous lesson. I want to do a recap because you will know that doing a co-integration test, not only able to do this intermarket spread, but that is also indirectly related to residual plot. Okay, is related, and these two are very, very useful strategy, okay, in trading FCPO and FQI. They are actually very, as long as you can do vertical calendar months on it, you spread trading, calendar spread trading, these strategies are very, very useful. Okay, so you can see I don't touch much on it because I have actually covered very extensively in the previous talk. So this is what you, if you have attended my previous talk, this is what you have learned. Yeah, so from here I want to carry on further. How can you do an intermarket analysis now? From there, that you have knowledge on co-integration, you have knowledge on stationary data. Now the data is stationary, and the data of the few calendar months, they are proven to be co-integrated. Okay, now you can do intermarket analysis, okay, as a foundation. All right, so for example, okay, FKLI, just now I talked a lot of FCPO. Now let's look at FKLI. FKLI, the correlation, okay, with intermarket assets. HSI, FKLI, NASDAQ, S&P, ES is S&P E-mini, YM is Dow Jones E-mini. So let's see whether these are correlated first before we talk about co-integrated. Yeah, correlated intermarket. So you can see from here, if you talk about FKLI, somehow NASDAQ is very highly correlated to it negatively, ES is negatively, and also YM is negatively. HSI doesn't seem to have very strong correlation or co-integration. Correlation here is correlation with FKLI. HSI has less. Okay, you can see from here. That's the result here. And from here, you move on. You didn't stop at the correlation test. From correlation test, you move on to Granger causality test. Okay, Granger causality is to one step further after you do a correlation test. Who is leading who is affecting who? So from here, from a Granger causality test, you can see that HSI leading FKLI, the probability, the p-value is less than 0.05, means it's significant. It's 0.0439. It means that it's significant. What this means is Hang Seng could be leading FKLI. Okay, and then down here, the Granger causality test for YM and HSI is Dow Jones. This is Dow Jones. Dow Jones is leading Hang Seng. Here it says that Dow Jones and S&P are leading NASDAQ. That's what the result shows here. Yeah? So this gives me trade ideas, intermarket analysis trade ideas, that if I want to trade NASDAQ, I could be looking at Dow Jones and S&P because they are leading Dow Jones and S&P to trade Nasdaq. I can form a quantitative model that is based on intermarket analysis so that I can trade my Nasdaq. Yeah, this is exactly what I do. I do trade Nasdaq, right? So for this FKLI, so if I want to trade FKLI as well, I could be looking at Dow Jones leading Hang Seng and then Hang Seng leading FKLI. So before I want to trade FKLI, I should be looking at Dow Jones and then I should be looking at Hang Seng, yeah, to trade. So this is intermarket, yeah, intermarket analysis. So this is what Granger considered. It gives you a clear idea who is leading who and who is not. As you can see, the leading here is not two-way, it's one way. It doesn't mean that Hang Seng leads S&P and S&P leads Hang Seng. It's just Dow Jones leading Hang Seng is just one way leading. Okay, so it's very clear cut. So if I want to trade FKY, I'll be looking at Hang Seng and Dow Jones. So that tells me that. Okay. Same for FCPO. Yeah, FCPO. So I'll be looking at things which are intermarket correlated to FCPO, which could be soya soil, soya meal, and soya bean. So you can see from FCPO, soya soil has a positive 0.85, very, very strong correlation with FCPO. Soya meal has 0.61, also very strong. So soya bean, soya oil, right? Soya meal and soya bean also have 0.846. Very, very strong. So all three, soya bean, soya oil, and soya meal, all three have very strong correlation to FCPO. That means that they could be leading FCPO, or FCPO could be leading that. We don't know, but we just know they have a strong relationship. But we don't know who is leading who, so you still need to go for Granger causality test to verify whether this relationship is one way or two way. So you can see from here that soya oil actually impact on FCPO and FCPO is impact on soya, so it's both way. Okay, FCPO impact on soya meal no impact on FCPO. Soya bean impact FCPO and FCPO impact soya bean. So it means that one can actually lead the other. So it's not an absolute thing. So that tells me that if you want to do intermarket modeling, we are not as sure as FKLI, where you are sure that Dow Jones is leading Hang Seng and Hang Seng leading FKLI. So that one is quite clear, right? You always look at the leader and trade the lagger. That's what intermarket analysis is about. But here, they are sometimes being led, they are sometimes leading. So that is not so clear cut. So it's proven that you want to create an intermarket quantitative model on FCPO using input as soy oil, soybean, and soy meal is not that straightforward. That's what it says. It's not that straightforward. So let's look at the co-integration. You can see the co-integration value here is negative 3.67. Okay, telling you that it is somehow co-integrated because it's able to pass 10% and 5% critical value, but it failed the 1% critical value for FCPO and soya oil. Okay, so it means that you could do a spread trading on FCPO versus soya oil. Okay, intermarket spread trading. Okay, it has at least 95% chance of mean revert. So it's actually possible. So that's what it says. I think those of you trading, you will know what I mean. Okay, co-integration between FCPO and soya bean. You can see the result is negative 3.31. It cannot pass 5% and 1%, but it passed 10%, means there's at least 90% chance that FCPO and soybean can mean revert. But earlier, there is at least 95% chance that FCPO and soya oil can mean revert. So if you want to choose which one, I think you will know, right? Which one has higher chance of mean revert, that should be the pair to choose for spread trading. Because spread traders, when they want to do a spread with FCPO, instead of calendar spread, they want to do intermarket spread. They will be deciding between soybean, soya oil, or soya meal, or those Dalian exchange yellow bean and all those things, which are also somehow correlated with FCPO. Yeah, those are locals, they will know what I'm talking about. So spread trading possible with FCPO and soybean is possible, and that is the residue plot. That's the reason why I brought up last lesson's residue plot, yeah, because it will be applied to this lesson as well. That's how you can actually do spread trading with FCPO and soybean as an intermarket analysis and intermarket trading strategy. Yeah. Okay. Now we identify the input. What products to put into this model? What are the inputs for the model? Okay. Like for example, you want to create an intermarket quantitative model for FCPO. Soya bean, okay, seems to be a good choice of the input. Okay, soya oil also seems to be a good choice. And then just now earlier for FKLI, you want to do an intermarket model. Hang Seng seems to be a good choice, and Dow Jones YM seems to be a good choice. Okay, so then we come to, what do we come to? Then we come to vector auto regression. That is where you already decided that all the data are stationary now. Yeah, we remove the grid root. Then you have actually tested the co-integration test, the CADF test, to ensure that they are co-integrated. Okay, so there is a reason why you should be using this to do an intermarket model. And then you already decided and you have tested who is leading who, so they are useful. And then finally, now you've decided on the input, what to put into the model. Now it's time to build the model. So the model I'm going to share with you. Of course, there are many other models for intermarket, which I cannot disclose all. One of the oldest one that I work with is called vector auto regression, VAR model, vector auto regression for co-integrated asset. How to use? Okay, this model is suitable for holding around 2 to 8 weeks in a trade. Let's say if you use this model and this model shows a signal, the holding period is about 2 to 8 weeks. So this is more on a swing trading or position trading. It's not so much of day trading. Yeah, not so much of day trading. Okay, so because to actualize the mean reversion sometimes takes time. Not necessarily within the next day it will mean revert. Not necessary. Okay, so the duration concept is very important, because let's say you try out the methods that I suggested or I share here, and then you say, hey, it does not work. Then I ask some of my previous participants, say, how long do you hold? Oh, I hold for 2 hours. Oh, if you hold for 2 hours, that's not what it's meant to be. You should be holding for at least 2 to 8 weeks for this strategy to work. Okay, so this model will utilize the relationship between products to further reduce risk by observing the theoretical value compared to the actual value of the dependent variable. Yeah, if they are different, you will actually achieve some margin of safety. Okay, you achieve some margin of safety. So the concept is VAR model is using ABCDE, which is correlated to F. They are intermarket product of F. And then we try to predict F, which is actually what you want to trade. So F here is referring to FCPO or FKLI. Is what we want to trade is F. But the ABCDE is whatever that is co-integrated or correlated or are related or can lead F. So just now we have already went through some of the examples. Yeah, so ABCD, you know what I'm talking about now. If you want to trade FCPO, which is F, or FKLI, which is F, right? What are the things that are leading them? You have an idea now. So linear regression model can cater for these needs. So again, back to eView, using a 3-variable relationship to form a VAR model. Okay, you can come up with what do I have here? Basically is FCPO is what I want to predict. And then here I'm using soya bean and soya oil. Okay, soya bean and soya oil. Okay, so I created a VAR model using eView. Okay, as you can see from here that 5 and 4 are very, very significant. Okay, why? Because the p-value is less than 0.05. Okay, what is C4? C4 is soya bean. Okay, what is C5? C5 is soy oil. So that tells you that you want to predict FCPO, you can actually put an intermarket model with an input, which is soya bean and soy oil, and you can see the D here means they are stationary data and they are very significant to predict FCPO price. And also C1 is the previous day data of FCPO is also very, very significant to predict tomorrow's FCPO price. So the historical data is also significant. Okay, you can see from here, right, that 3 things are significant in this VAR model to predict FCPO price. That shows you that the VAR model shows you that soya oil and soybean have a significant impact on FCPO. So if you trade FCPO, remember to take this into consideration. Yeah, soybean, soy oil. Okay, that's what the model shows. And here, Dubin-Watson on statistics is more than the R square is also 2 is a healthy value. That tells you that this model is not a spurious model. It is not a bad model. It's not a wrong model. This model is valid. That's what it says. Okay, RKK information criterion tell you how effective is a model. Okay, and source criteria to tell you how effective is the model. And the F statistics show you that whether this model is significant or not in predicting. Okay, all right. So from this model, it's okay. Now I know the model is good and blah blah. So what's next? How can I use this for trading? Right. So next is you extract the formula from the model. Okay, and this formula that you extract from the model, okay, you can actually substitute out all these values from this model. Yeah, these are the values or the coefficient values. You can substitute them all into this model, and you copy and paste this whole formula into your trading coding, your trade coding. If you are coding in Python, copy and paste into Python format. If you are code your strategy in C++, copy and paste this formula into C++. If you are doing it in MT4, MT5, right, you can copy and paste this in C++ format inside MT4, MT5. So this is MT4, and MT4 is used to trade FCPO. Let's say I'm using MT4 to trade FCPO. Copy and paste this intermarket factor auto regression model into MT4, and this will be how it looks like. It's in C++ format. Okay, after you copy and paste inside, you'll be able to create an indicator that looks something like this. Okay, looks something like this, technical indicator. So you can see that most of the time, the fair value doesn't deviate too much, then suddenly the fair value comes out. It could tell you that, this is just an example, it could tell you that FCPO or FKLI, the price could be coming down soon based on intermarket quantitative model. So you can see that it's actually suggesting that, of course, all these things can be automated, and then the system can automatically make a short when this happens. The fair value discrepancy signals an opportunity to short. Okay, this could be FCKLI, can be FCPO. Okay, so you can see that, and then the short point is based on the linear regression formula. You short here, or the system short here, and then you can do down and down. This will take about 2 to 8 weeks to evangelize the mini trend, the trend. Okay, you need to hold, right, and then you can make it into an automated system, which I used to do that. Okay, make it into automated system. Okay, and it has auto stop loss, auto take profit, and all these things. Yeah, I created this style of systems quite early days, some times ago. Yeah, more than 10 years ago. I already started to work on this type of project. Okay, so intermarket does not only need to be products which can be traded, it can also be products which are not traded but are related. Like for example, VIX, okay, for example, gold, for example, catastrophic events like virus can also be an input. Okay, the HYG 2 ETF ratios can also be an input if they suggest a RORO. RORO means risk on, risk off suggestion. Okay, so these are some of the things adopted from our robot framework I bring out to analyze. So input not necessarily must be all tradable products. It can also be non-tradable products. It can also be basically factors which are critical success factors. What influence this price to move? What influence FCPO to move? What influence FKLI to move? It might be certain factors which you have not thought of, which are important. So it's very important you know what caused price to move. So in order, so you don't say that, oh, throw everything to the AI will handle everything. It doesn't work that way. You have to tell the AI what is important, because this is not an unsupervised learning. This is a supervised learning. Unsupervised learning like AlphaGo Master, that is too high level. I don't have that type of technology, but that is possible. The AI can learn itself, but I don't have technology. Mine is still very much has to teach the AI what is important, and let the AI map the pattern, okay, and carry on the prediction. So macro impact factors for regime shift, okay, could be this. Okay, so this is just an example. What could influence FKLI? Could be these things like yield curve, right? Like the 10-year treasury yield, the S&P, like economic data release. Okay, these are what they can influence an index. For example, S&P index, NASDAQ index, or FTR index. These are the things which could be an input into the intermarket model. So it's very important. It still rely back on your experience. What influenced the price to move? If you don't know, you cannot just rely on software to help you to predict. You have to tell the software what to do. Okay, so application of our model to develop leading indicators of FCPO and FKLI, the automation part. Okay, so now let's talk about the automation part. How to automate? Now that you have the indicator, you have the model create an indicator. Indicator are all developed into MT4, and MT4, how do you automate in the local platform like RHB, Maybank? How do you automate, okay, into any of the local brokers that you're doing? Okay, so this is how it's done. You can actually get the data first, okay, get the backend processor to process all these things, make some prediction, some form of quantitative model prediction, okay, using R, and then from there, or using Python, okay, as a backend data processor, and then send the prediction back to MT4, and from MT4, send to local brokers like RHB for execution, or any other brokers that you have in mind, which are all of them using different API vendor. So the whole process of prediction, extracting data, passing or firing order, and executing in local platform of your choice, the whole process can be fully automated. Okay, fully automated. So this is an example of you want to do all these things in let's say JF Apex. Okay, they are using TT, trading technology, and you have to pass their UAT certification. Okay, user acceptance testing, in order to fully automate Apex. Let's say you want to fully automate in RHB, you have to pass QST, Quick Screen Trading's API vendor certification. So you have to go through, make sure your algorithm has no issue, and then this is the whole process. You connect. Now you have the algorithm, right? You pass to their API vendor. In this case, this broker could be using PET system, and then they will help you to pass the broker. The broker will help you to execute in the exchange. So FCPO could be CMA Exchange, and FKLI is Bursa Derivative Exchange. Okay, so this is the connectivity if you want to fully automate. So I'm going to share an example how to fully automate in one of the brokers. Two brokers are using QST, is Affin and RHB. You can fully automate FCPO, FKLI trading in that through QST. And if you are using other brokers, that's fine. You just have to find out what are their API vendor. The process are similar. Okay, doesn't mean that you can only do it in these two brokers. Doesn't mean. I'm going to share with you. Okay, so if you're using RHB or Affin and you want to fully automate FKLI, FCPO trading using intermarket analysis that I just shared, that quantity model, fully automate, the model is now stored in MT4 and want to link to QST, link to RHB or this Affin through QST, that's fine. That's what we are doing now. So open up the Spider. This is using Python. Click the file. Okay, click the file. And then from here, click open. Okay, click open. All right, click open the file. Right, this is in Python format. Yeah, so how to install this Python format? Very simple. This Spider tree comes with Anaconda software. So if you are familiar with machine learning, you will know that Anaconda is a very user-friendly machine learning framework. You just have to install Anaconda. It comes with Jupyter Notebook. It comes with Spider. It comes with Anaconda prompt. Okay, you will know that that is actually where you can store all your strategy in your files. Okay, so click open, and then copy. Click open this demo copy. This is given by the vendor, given by the broker vendor. That this is how you can connect to us as the broker. How you can connect to us through our vendor. And then the script up here. All this script is given by the vendor. Okay, right. And then, for example, I'm using RHB. You open up WinRHB. Okay, in the desktop. Okay, wait for the desktop to launch. Wait for the app to launch. Okay, and then here you will have the setting, because you have the login screen. You have the setting, and from the setting you can choose one of the broker server. Let's say this QST Hong Kong server. Click the right server. Okay, and from there click log on. Key in the right username and password. Then you will come to this page, which is the account information. Is this your account? Is this account now linked? Okay, means that is your home MT4 PC, is it linked to your broker now through QST API vendor? Okay, through their software. So you can check actually your account detail. Okay, that's my account. I have about 100,000 inside, for example. These are my RHB futures account. That's correct. That's my name. These are the products I'm allowed to trade. Okay, the product details. These are the products I'm allowed to automate. Okay, in RHB. Okay, they already I passed that to their so-called UAT, user acceptance testing, and then these are the products I'm allowed to automate fully using my my intermarket quantitative model. Okay, so you have the details of the products that you would like to trade prior to placing an order. Okay, so to place an order, click the web page. Okay, click the web page. Of course, not you placing an order. For the algo to place an order, you have to click the web page, click the web API JavaScript demo. Okay, for example, and from here, the web API JavaScript demo page will appear. And from here, you can actually choose, click the order entry. Okay, the order entry here, right? Click the order entry here and select the order entry properties. Okay, select the order entry properties. And from here, you can choose this one. Okay, these are the two. You just choose one. Basically, the broker's API vendor, they will tell you step by step, this is how you should use our software to connect and all this. Okay, so if you are not sure, doesn't matter, the API vendor will assist you. Okay, because they want your business, so they want you to automate. If you know how to automate, by all means, go ahead. you have consistent revenue of commission. Why not, right? You keep trading. So select the edit configuration, and from here, key in all the relevant thing, including your username, port number, and password, and all these things. And from here, click OK. Click initialize connection. Okay, click initialize connection. This is actually set up in your own PC in your office. Okay, like we have one in the office. Once the connection status is shown as connected, that means you are already successfully connect your local PC, okay, with all the strategy in MT4 or in Python. Okay, you have successfully connect your home PC to the broker, and you can fully automate the trading strategy. If this shows connected, okay, in green, means your connectivity, your API, your APIs is application programming interface. Your API's connectivity is fully successful. Now you can automate. You can automate, okay, and then ensure that you key in the right input for host, okay, key in the input for contract, all these things, okay. All right, these are all the basic setup, and then the strategy will be fully automated, yeah, according to your setup, everything, okay. Retain QOR as the input for provider, and then click run, okay. Ensure that the trade is successfully automated. Click OK here. See, check that whether it's OK here to ensure the trade is successful. Once the trade is successfully fired, you will see an OK here. So check for the OK here. You will see the terminal where you have the trade journals. The journal shows everything that's happening. Okay, you will actually have, you keep a record, a history of everything that's happening. Okay. To check whether the trade successfully, you can always go back to our RHB platform and check that the trades are in the orders and positions monitor. You can see, oh, this trade has been fired through. Good by the system. Using my intermarket model, fire through in MT4, directly bridge over to RHB through QST and fire in QST and execute in RHB. My RHB account is fully done. Okay, so the details of your place order will appear here. That's how it's done. Okay, it will actually appear here. Okay, right. So okay, an example, yeah, short side is the left hand side is actually sell. What is the chances of it going down? The middle one is chances of going sideways. The right hand side one, the green color, is the chances of it going out. So this case means for the Nasdaq, there's a high chance that it will go up. Yeah, short side long probability of this is one of the machine learning. Right, machine learning, you can see here that is LSTM strategy. So here it shows that it should be going up. So the system will actually make a trade. The system will actually make a trade. So at that date, the LSTM, which is long short-term memory machine learning model, it predicted a high chance of Nasdaq going up. What does that mean? It means KLCI will also go up. So based on Nasdaq going up, this machine learning model, the system long KLCI, FKLI trade based on the prediction of Nasdaq index. Okay, intermarket model using machine learning, fully executed in RHB, fully automated. Okay, fully automated in RHB. So that's one case study that we have, and that is our machine learning. Okay, that's our machine learning. All right. So from here you can see here that was the trade done. Okay, buy at certain thing, and then okay, that was actually a trade. I don't know whether do I have the trade receipt here, but I'm supposed to attach a trade to prove to you that this trade was successful, but I don't know whether they put that in. Okay, so that is a good example of fully automated. The model is intermarket, okay, and the execution is also the intermarket, not just the intermarket alone, but also using enhanced by machine learning called LSTM to map the pattern of the intermarket analysis and see whether what is the right time of execution and stuff like that. Okay, and the exit entry, all this can be done using quant model, using Gutsch and Arima. This is the time to short, there's the time to long, there's the time to short, there's the time to long, there's the time to short. This is for FCPO 60-minute chart, and this will appear on the screen. Okay, when to long and when to short. So all these indicators are these are all customized indicators based on, could be based on intermarket, it could be based on volatility and enhanced by machine learning. Okay, right. So that's why I was talking about adding machine learning feature to a VAR model, to an intermarket model, enhance it with machine learning. How do you enhance it with machine learning? This is what I was shared earlier. You can install Anaconda, and it comes with TensorFlow, Keras, Python, Spider, Jupyter, Atom, and also machine learning libraries like RNN, LSTM, scikit-learn, all this. It comes together in Anaconda. Last time we used to install one by one. Now you just have to install Anaconda. Everything will come with it. Okay, so if you want to try out machine learning, okay, this one I already talked in the previous section. Okay, so I'm not going to spend so much time to talk about that. You can always install Anaconda, pick this tool, and then you'll be able to have machine learning added feature onto your intermarket analysis, okay, and TensorFlow, Keras, and you can install all the machine learning libraries through pip install command using Anaconda prompt. Okay, if you are not programmer, you want to use basic plain English to do programming, you can use Jupyter Notebook, which is more English friendly. But normally we use Spider. We use Spider Notebook to Spider tree to actually do our programming of our strategy. Okay, all right. And then the linkage is using 0MQ. 0MQ is the secret, which a lot of people do not know. How do you link MT4 to execute in RHB? How do you link MT5 to trade, let's say, Bursa stocks in MT5? All right, and how does MT5 fire Bursa stock orders to execute in Kenanga or execute anywhere? It's actually through 0MQ. Okay, so 0MQ is the link. I'm not going to go into detail. These are all trade secrets, but that is actually the way to actually do it. Okay, so after you link everything, then next is the machine learning model, where you have all the standard steps: data acquisition, cleaning, training, testing, train model, evaluate model, and deploy the model. Okay, so example, the data you have until the last data is 2424. You put into machine learning model, the LSTM will predict the next few days it will go to 2444. That is the prediction. This is the prediction. Yeah, it predicts that it will take a few days to rise in 20 points. Okay, so in reality, it took only 2 days before the price went up to 244. The exact price predicted by the machine learning. So the background is still intermarket, but we add on one layer of machine learning to map patterns. So you can see that it actually can be, intermarket analysis can be very powerful if you use it correctly as the core of your strategy. And the core of intermarket analysis is the right input. The right input is the most important. If you've got the wrong input, you will never have very accurate prediction. You must know what caused the price to move. The right input is the most important. Then you can automate the periodical price forecast like every week, do one forecasting, all the potential using Monte Carlo and one most likely path. Okay, and then you map out the path, like for example, at this point, it might come down. At this point, it might go up. So all the dashed line are the potential path that the price will go. Okay, right. So that's actually the machine learning part. Okay, machine learning part. All right. So that is added onto the intermarket analysis. Okay, so it's actually very, very important that you know, like if you want to use quantitative models, why use intermarket, right? Because some are leading, some are lagging. That's the reason why if everyone is moving at the same pace, no one is leading, no one is lagging, then intermarket doesn't work. Okay, so even if intermarket is working, then can you just use intermarket alone? The answer is yes. Without machine learning, the model still works. But if you want to have more precise, let's say, prediction, machine learning can be added as one extra layer, okay, to intermarket. Okay, so that is actually the extra intermarket analysis plus machine learning. So we don't just stop at intermarket, and the bridge over from the creating the model in this eView, okay, and from eView you extract out the formula, put into MT4 in C++ format, okay, or into the Python format, and from there you have to bridge over to the local brokers through their API. So you must be able to have, let's say, QST, okay, quick screen trading, okay, and then from there you must be able to link to your broker. So what you want to see is the full connectivity. So if you ask me, okay, Alex, you have talked so much, all these things very, very deep. Has anyone done this successfully? Has anyone fully automate their FCPO trading, FKLI trading, and have actually good track record of fully automate this whole thing? The answer is yes. There are people who has, at least some of them have actually 5 years track record, fully automated, and this can be done. Okay, and even if it's not fully automated, they at least have strategy. that actually works. So so what I want to say is that don't just rely on technical analysis, right? You can go deeper than that. And there are people who are successful in trading FCPO, FKLI. Definitely, they think much more deeper than just looking at charts, than just looking at candlesticks. Okay, there are many things. So this today's sharing is meant for you to open up your mind. Trading is very fun if you actually think about strategy to win. Okay, trading is not fun if you don't think of strategy to win. Then trading is not fun. If you think of, wow, trading can be so many things, can be machine learning, can be automated, can be also intermarket. If I want to trade FCPO, I even have to look at soya bean, I have to look at soya oil, I have to look at soya meal. Wow, trading is so interesting. So this sharing is meant for you to open your mind that you do not need to be boring during MCO. You can actually have very interesting learning as long as you have passion and you're really interested. Okay, if you're really interested in this thing. Okay, so today's sharing is very surface. Okay, and I won't say that I'm an expert. I don't handle the whole thing. I have a team. So it's very important for you to know what I'm trying to say here. Okay, that this whole thing can be automated. So you can replace PAT system as API vendor depending on the broker. So if it's a certain broker like public bank, whatever, it can be another broker, okay, which I can't remember the name already, Excel Learn or something like that. It's Excel Force or something like that. Yeah, if it's Jet Apex, it's actually TT, and if it's some of the brokers use CQG. I remember Yukata is a new broker. They use CQG. Is a new Japan broker that come to Malaysia. They also have FCPO, FKI, and then there are many brokers. Okay, so I'm not sure which broker you're using. I'm totally broker neutral. I'm not promoting any broker. So here it's just meant for you to have an interest in trading, like Bursa products like FCPO and FKI. Of course, this apply to any other futures as well, like Nasdaq, S&P also. Okay, not just FCL, but today's focus is that if you want to trade Malaysian futures, how interesting can it get? That is actually the question. Okay, that's actually the question. So I hope that from today's class, okay, you are able to have an open mind and learn something from it that is actually can be quite fun, right? This is through intermarket analysis of FCPO and intermarket analysis of FKLI. Okay, it can be quite fun, and it's not just necessary just, oh, look at the candle looks like it's going up, so we should buy FCPO. The candle looks like it's coming down, got black candle, so we should short. It's not as simple as that. So those experts in the locals, they are doing spread trading. So spread trading has its trade secrets. Outright trading also have its trade secret. Intermarket trading have its trade secret. So we are going into very detail how is it being done. Okay, all right. So we are almost coming to an end. Okay, it's almost 9:40 already. So I hope that today's sharing will actually open up your mind. It's meant for education purpose only. So if you have any question, of course, welcome to ask me. I might not be able to answer all your questions, but I'll try my best to help you to embark on this very interesting journey of trading. Yeah, I've been in this journey for quite some time. Until today, I'm still quite passionate about it. Okay, because it is my area of interest. It's quite fun. I would just say it's just fun to trade, to learn how to trade and to create strategies, and don't just listen to tips. Yeah, please learn on your own and think of strategies and think of how to trade by yourself and with a group of friends. It's quite fun, but don't just listen to tips and trade blindly. Don't just listen to a reminder, buy this, sell this, and trade blindly. Don't have the knowledge. So that's what today's purpose is for. Okay, so thank you very much. I would say, okay, I'll pass the mic back to So. Okay, thank you so much, yeah, for today's sharing. Okay, all right, I'll stop sharing now. Thank you so much. All right.
All right, thank you, Alex, for your sharing. It's an interesting topic. And one of the takeaway that I learned from today is that, especially on the correlation part, where I see that you have run a test on the correlation between Dow Jones, S&P, as well as FKLI. So from there, one of the result it shows is that Dow Jones and the S&P actually has a negative correlation towards FKLI. So for those of you who trade FKLI, you already understand whether is it worthwhile to look at Dow Jones and S&P to predict FKLI movement or not. Okay, now we will be opening up for a Q&A session. So if you have any questions, remember to type your questions in the Q&A box. and make sure it is sent to all co-hosts. Only there I will be able to grab your question from the Q&A box. All right. So all you need to do is actually follow these 2 steps so that I can receive your questions. Now, for some of you, if you have urgent things to do or would like to leave for whatever reason, and before you leave, please give us quick feedback where you can scan this QR code or find the feedback form link in the chat box below. All right. And let us know what are the topics that you would like to cover and what would you like to learn so that we can improve further on our end to provide you a better learning experiences. So let me have a look at what are the questions that you have already put up here. Okay, the first question, can retail traders also automate their trading?
Let me unmute. Okay, good question. The answer is yes, of course. Yeah, I'm sure there are a few brokers that are very friendly to retail, for example, RHB, and of course some other brokers as well. GF Apex also, I believe. Affin also, they are very, very friendly to retail. So as long as you have the technology, of course, they are not going to provide you with the algo. You have to come up with your own algo, but they will assist and facilitate the connectivity and help you to automate this. Of course, retail can do it.
Okay, I see. Following up with the same question, if we are able to automate it, then do we need to set up a company or pass any security commission paper in order to automate our trading?
Okay, if you are just a retail investor and you're automating the trading for your own retail account, there's no need to do so. Of course, rules and conditions and all these are not my expertise. Of course, you have to ask your broker, are you allowed to do it? Instead of asking me, it's more advisable. But as far as I know, yeah, up to my best knowledge, you don't need to if you are just doing it for your own account. Of course, if you're doing it for a fund management purpose, let's say you are very good at trading already, you want to manage other people's account, and then you might need some form of license. Also, that one you will need to ask the authority. I will not be the best person to ask.
Okay, another question. Are there any shortcomings for machine learning prediction?
Oh, there are definitely a lot of shortcomings for machine learning. Machine learning is never perfect. How perfect is your machine learning? How good is your machine learning? You can see from the AlphaGo movie. Yeah, you can go to YouTube, search AlphaGo. You can see there are still times where even the really, really complicated ML machine learning AI can lose to human. So they are definitely full of flaws. And of course, how well you train your AI is actually how well you will perform. It's just like a child, you're going to teach it the right thing. Like for example, MRN technology, machine learning, reading news technology. You teach your AI how to read news, how to read English, how to read Chinese. If you teach it wrong, you interpret everything wrongly. So it's very much up to the person who the brain is implanted into the AI. Like, who are you getting all this experience from? Is it a very seasoned trader or is it a newbie trader? So that part, but in conclusion, ML models are still full of flaws, up to date. Nothing is perfect.
I see. Well, Alex, can you elaborate a little bit further on what are the, for example, what are the most commonly seen shortcomings for machine learning prediction?
Okay. Commonly seen shortcomings. Okay, very, very simple. If the market has changed, the machine will not know. For example, I give you a very good example. Machine learning and all this algorithm trading, let's put it that way. Algorithm trading started in 2006. Algo war started in the US in 2006, 2007. That's pre-QE, right? 2008, as we all know, we have a financial crisis. And the way the central bank solve the financial crisis is through QE, quantitative easing. When we do QE, the whole market change. All the chart patterns change. So if your machine is based on, if your machine learning models is based on, let's say 1990 until 2006 data, and you're trading in 2007, okay, it still works. But when it comes to 2008, 2009, the machine will suddenly say, what happened? But it will still rely on the past pattern to predict, or the past model, because you store the model to predict. So it will be wrong. The accuracy will go down a lot. So the shortcoming will be, one example will be, it's still based on past history. It's better than human in remembering history, but all we have is history. We cannot see that in the future the market has substantially, fundamentally changed. We do not know. So the machines, one of the shortcomings is still very much based on past data and past patterns. That's one of the biggest shortcomings.
Okay. Upcoming question would be, can we actually use a fundamental analysis for the quantitative modeling?
Oh, definitely. Of course, our firm also we use basically use global macro for our AI to work. For our AI is very much macro engine driven. It's not technical driven. It's fundamentally driven. So a lot of good models, like for example, let's say George Soros. Yeah, if I'm not wrong, of course I don't know his exact strategy, but through his published book, Alchemy of Finance, he is very much a global macro guy. So he's using fundamental macroeconomics to basically put into his model, and he's not using technical analysis. So a fully automated model doesn't need to be technical or just purely data driven. It can also be fundamental. And I would say fundamental models can make very, very good machine learning models.
Okay. Yeah, Alex, can I fairly say that quantitative modeling is not just technical and not just using mathematics and statistics only, but also using those fundamental data that we convert those data into mathematical form in order to do our forecast and analysis.
Yeah, yes. A best example, I think, to write on that, the best example will be quantifying news. News are fundamental, right? Fundamental, we talk about, let's say, reading news, right? Reading today's newspaper, say, Goldman Sachs say something, the Fed say something. These are all fundamental data, right? Convert into machine readable format. That's a good example of quantifying fundamental and quantifying news. Yeah, definitely you can quantify fundamentals data. Let's say what we call that EDR, this economic data release data. Okay, all the dot plot, Fed dot plot data. Okay, and also all the Fed delivery speech. You can quantify the speech, and you also quantify all the news. So that's an example of quantifying fundamental. So systematically analyze and quantify fundamental can be one form of quantitative modeling.
So okay, for those who who are new in quantitative modeling, so you can already understand that the Alex explanation that it is not just only purely mathematics, it also includes quantifying fundamental data into a mathematical form. Okay, next question. Is technical analysis part of quantitative analysis, or in other way, is quantitative analysis part of technical analysis?
Good question. I would say quantitative analysis is evolution of technical analysis. In the past, as I say, all these statistical methods were all borrowed from other disciplines. Right? For example, a lot of these quant methods for trading are borrowed from. In the past, all these disciplines were not available yet. The technicians, right, like Martin Pring, like John Bollinger, they do their best. What they know at that kind of time. Like for example, during the Turtle program, right, all they have is an average true range, but average true range is their science. But they quantify risk using average range. Today, everyone has average true range, and to us, it's a very raw and very, very simplistic way of quantifying risk. But at that time, it is science. So I would say that as long as you analyze a very simple indicator like Bollinger Band, even moving average, or even let's say just average range, from the formula perspective, and see, does this formula make sense? You're already doing quantitative analysis, even though it's a technical indicator. But if you are looking from a chart perspective, let's say, oh, this candle looks like that. This candle looks certain pattern, head and shoulder pattern. This is more on visual, and it doesn't have so much of mathematics behind. Then it is pure technical analysis. So I wouldn't say technical analysis and quantitative are not related. They are related. And technical analysis, so far, all the old indicators are a very primitive form of quantitative analysis. If you look at the formula, then you can modify the formula. Okay.
Very good, Alex. So for those of you who may be still new in technical analysis, you may just see technical analysis is maybe just chart only, but in fact, traditionally speaking, technical analysis is also already using quantitative analysis in creating their indicators. For example, even moving average is also a form of quantitative analysis. All right, next question. I think this question is a little bit more advanced. Theoretically speaking, can we use or feed prices of those FKLI, those KLCI 30 component stocks into the VAR model in order to trade FKLI?
Yeah, theoretically speaking, yes, of course. Theoretically speaking, there are many variables that could impact on FKLI. Like for example, the 30 component stocks, of course. But there are such things as conflicting of each other. So there were certain statistical tests that show conflict. Like for example, the VIF model shows it's more than 10. That means a few of the variables are conflicting, giving very confusing results. Or there are the AKK information criterion showing very bad results, telling you that you have too many inputs. There are such things, okay? For statisticians will know what I'm talking about. So you have to consult a statistician and see whether all these inputs, do they jive with each other? Do they complement each other or they are in conflict with each other? So there are such a problem that you face that you might not be aware if you are non-statistician, okay? So, but it's a good idea, definitely theoretically it's possible. You always start with dump everything inside, okay? Then realize, these are all unnecessary, then pull them out. Then until left only a few which are really core of what influence this price to move. So of course, in theory, you can put all the 30 components inside, but how effective it is, you have to try, then only you know.
Okay. Next question. How to learn quantitative modeling in a more systematic way?
That's a good question. There are some books in Kinokuniya, of course. You can go and buy a quantitative modeling books, right? Like E.T. Chan, all these books. They are, of course, you will say, very boring to read books. They are also online. Let's say this lynda.com, all this seminar, CompTIA, all this. Of course, I'm not sure which are the local seminar school. Like for example, Better Excel Learn has provided all these quantitative classes, in their official offerings. I'm not sure. But there are a lot of academies that are offering this. There are some academies in Singapore quite well known, also offering quantitative classes. But again, it's actually up to your passion. I believe if you are passionate, you will definitely sit around and see which are the good ones, and you ask around. Yeah, but there definitely are YouTubes, academies, and all these CDs. Yeah, okay, CompTIA CDs. All these you can actually get out. Of course, there are also what do you call that? Certificate in quantitative modeling from well-known institutions like Cambridge, MIT, Oxford. They are all offering this type of quantitative trading certificates. You can go to their website and search. I actually passed one of those. Yeah, I think it's from Oxford. I passed the Oxford one. Yeah, algorithm trading certificate. Yeah, I think it's quite good. You learn something from it. That could be a good start. Okay, thanks.
Oh yeah. On top of that, prior for those Alex, for those certification that you mentioned, that are there any prerequisites that if our participants would like to learn, what are the prerequisites before we actually jump into algorithm trading or quantitative modeling?
Okay, good question. For example, basic classes in a few of the academies in Singapore, including in all those well-known institutions like Cambridge, Oxford, MIT, Harvard. A lot of it is for new beginners, because they do not require programming skill. There are also more advanced level certificate where you need certain prerequisites, like you must know a certain basic knowledge of trading or programming or data science or something. But there are definitely some that you can start with actually absolutely no knowledge. There are such certifications available. Because I checked them, that's why I selected one of them, which is actually the Oxford one. Therefore, of course, I'm not promoting Oxford here, but I'm just sharing with you what I did. And there are those that you don't need knowledge. Yeah, there are those that you need.
Okay, one more last question. Is it essential to have fundamental analysis knowledge in order to do quantitative modeling?
Okay, good question. Quantitative modeling can be pure technical model. Okay, input. That's why I say input. Remember, I focus so much on input. The inputs can be pure technical. It can be pure data science. It can be news-driven. It can be very fundamentally driven, like global macro-driven. So not necessarily must be only technical, and not necessarily must only be fundamental. It can always be a combine of both. Before that, you have to see, have you got a strategy that works when you do manual trading? That's actually a more important question. If you have never had any strategy that works, means you don't know how to trade FKLI lah, or FCPO lah. Okay, recommend you to come to learn from Excel. just kidding. Okay, but you must know what you're doing lah. Then yeah, but you can be pure technical, pure quantitative, pure fundamental, or it can be a hybrid. Yeah, it doesn't have to be fundamental in nature, because there are a lot of successful traders that don't use fundamental at all. They can actually still make money. That's a fact.
Okay, so can I fairly say that quantitative and types of trading actually opens a lot of a variety of ways in terms of creating trading strategies?
He actually opened up a Pandora box. So a lot of people actually blame Emmanuel Derman for that. Why does he have to be the godfather of quantitative modeling? It makes life very difficult for nowadays the trader, but it makes life so interesting. You see, without quantitative analysis, last time we only have TA and FMR, right? Quite boring, right? So now you have QA, and then you have SA, sentimental analysis, right? Detecting the tone of Powell as a form of technology, using satellite technology, using those tower beaming orders, or and also detecting the sentiment of the public using certain form of wave detection. These are all very interesting technology nowadays. So trading become a lot more interesting because of all this new technology.
All right. Okay. Thank you, Alex, for your input as well as sharing. Now, before we end this, I believe we have answered many of your questions, and it's about the end of the webinar session. So before we end this session, I would like you to take 1 minute of your time, just only 1 minute, to fill up this feedback form. You can scan this QR code, or you can find the link in the chat box below. It actually takes you less than 1 minute to finish this feedback form. So let us know what are your thoughts, comments, as well as your feedback, so that in the near future, we are able to improve further on our site and give you a great value content as well as learnings to improve your game in your trading. All right. So just a quick 1 minute, and later on, we will continue our remaining session. Okay, time's up. If you have already submitted your feedback, I appreciate that. And thanks a lot. While for those of you who haven't finished yet, you can continue to finish your feedback form. And thanks for your participation in giving us your feedback. And we will strive our best on our side to improve in the next upcoming session. Now, as I've shared with you previously, that this is a LLF Futures webinar series. It is a series of topics where we will be conducting every Tuesday evening, same time from 8:30 p.m. until 10 p.m. And there are lots of content pack as well as informative topics where you will be learning some practical knowledge about futures trading from our experienced speaker. So if you'd like to join any session, you can scan this QR code and register the topics that you would like to attend. And once you scan this QR code, or if you can go into this link, you will come to this page and there will be an event calendar. So all you need to do is that find the topics that you like on the Tuesday column, click on it, and then register yourself. And another one would be on the LLF online workshop. So this workshop is a step-by-step workshop where we will be guiding you how to kickstart your trade in futures. So it is a very detailed class from A to Z for beginners, and it is only for those who are serious in getting start your futures trading. And every session we will be limited to the first 50 online attendees only. So only register if you are serious in learning futures trading, and do remember, be quick to register this LLF online workshop, because on 27th November, this would be the final online workshop that we will be conducting for the year. So if you have missed any workshop in the past, so make sure that you register yourself in this upcoming date. Okay. So because in the previous sessions, some of them, when they want to register, right, they really want to learn, but they are unable to register it. So make sure, if you would really want to learn, and if you missed out the previous session, so don't miss out this very important date, because this is actually the final session that we will be conducting. And if you scan on the QR code or go into our website, same thing, on the events calendar, you can find on the Saturday or the Sunday column where you will be finding the LLF online workshop. It will be conducted either on 9:30 to 12:30 p.m. or for afternoon session 2 to 5 p.m. Now, before we end this session, let me introduce you to this Bursa Academy. This Bursa Academy website is actually a comprehensive one-stop e-learning platform where you can actually get all of the information and knowledge about stocks, futures, and any other products that you can trade in Bursa Malaysia. You can scan the QR code on your right here, or you can Google search Bursa Academy and make sure you are able to find the link. Believe me, Bursa Academy has plenty of information as well as videos related to trading. So you can actually access to Bursa Academy for even more information. All right, this comes to the end of our session today. Thanks to our speaker, Alex, for sharing his insightful and knowledge topic on the intermarket quantitative modeling for FCPO and FKLI trading. And I thank you all for your participation. And I believe you have learned a lot of informative knowledge and broadened your perspective about quantitative analysis, about intermarket analysis for FCPO and FKLI trading. So with that, I'm CY. I wish you stay strong, stay safe, and stay healthy. I will see you next time. Good night and bye-bye.